Adab, Namaste, Sat Sri Akal. Welcome back to my channel Curious Prerna. This is Prerna and today I am back with another very important and demanding topic. What are mutual funds? Like how to start investing in mutual fund. I get this question so many times on my Instagram. So I thought why not to make a video on this. Okay, so let's jump into it. But before that, if you are new to my channel, please do consider subscribing. I come with this kind of videos with knowledge, minimalism, financial advices every Sunday. Okay, and if you have already subscribed, thank you so much. So, very quick overview what we are going to discuss today. Of course, about mutual funds, difference between a mutual fund and a share market, types, the kind of schemes, SIP, lump sum, two very important rules of investment, and then there is a bonus for you waiting at the very end. So make sure you watch it till the very end. Okay, chalo, let's do it. So what is exactly a mutual fund? Mutual fund is a pool of money collected from a small and medium investors and then invested in stocks, debt, real estate, gold, yes, gold, and many funds like that. Now the question comes, if the mutual fund itself invests in stock, then why not to go and invest in the share market itself? So I'll give you an example. Suppose you decide to throw a birthday party or any party for that matter, and you have two options here. Number one, you can decide on the decor and food items, catering and everything yourself, but there can be chances that you must be busy. You must be having your own work to do. You must not be an expert in that area of decoration and food. Still, you decided to throw it and you threw a party which could be a success or could not be a success. However, the second option which you have is to hire a party organizer. So they are the expert in their area and they give you the best result, right? Exactly, that is the difference between a mutual fund and a share market. Share market is something where you go yourself, decide on the right kind of mutual fund, do all the financial analysis. Sometimes you don't do on the financial analysis and buy some kind of stocks based on all the rumors in the market and the news. Whereas if you are not an expert, it is always recommended to go through a mutual fund company. So as an investor, you, me and people like us, thousands of people like us who are not having a clear understanding of the market, who don't have enough time to go and research, they pool a certain amount of money every month. Like for example, I decided to contribute 2,000 rupees, XYZ decided to contribute 5,000 rupees and so on and so forth. They all went to a mutual fund company and decided to invest in a particular scheme. We'll come to that scheme later on, okay? Just keep watching. Decided to invest in a particular scheme. Now there is a fund manager who is expert in his area and who has a suitable knowledge to do that. He will invest your money in a stock market or in a debt or in a bond, okay, or in any kind of fund which you want to invest in. So now when it is clear why you should invest in a mutual fund and what is a mutual fund, we'll move ahead and discuss upon the types of mutual fund. Mutual funds are divided into various categories based on different objective and schemes. However, today we are only going to discuss about the asset class. But if you want to know about the other funds in details, just let me know in the comment section. I will be very happy to make a video on that as well. So when I talk about equity mutual fund, basically I am talking about the investment which goes into the share market. Anything related to share market is the equity market, okay? When I talk about debt are the bonds which are floated in the market by any company, and these are relatively safer instruments like commercial papers, government securities, bonds and all those. And these give you a consistent return, not as high as the equity mutual fund, but they are generally on the lower side, but yes, risk associated with them is also on the lower side. Then number 3 comes the hybrid fund. So hybrid fund, as the name suggests, it is a combination of equity fund and debt fund. So when you go to a mutual fund company and you decide on a scheme and you say I want to invest in a hybrid fund, it could be like balance fund and there are various names there. So when you tell I want to invest in a hybrid fund, your money is invested in both equity fund and debt fund in a certain percentage contribution. Okay. So now when it is clear what are the different types of mutual funds, we will understand what are the schemes through which we can invest in these kind of mutual funds. For that, we'll see what kind of companies generally are available. Number one is blue chip company or large cap company. I'll not separate them. I'll keep them in the same bracket. Then comes the medium cap company, and then come the small cap companies. So before explaining these schemes or the companies, I would like to introduce you to two cardinal rules of the investing. Number one, whenever you are getting a high return, there are very high chances that there must be a high risk associated with it. So even if somebody comes you and tells you will get a more return more than fixed deposit, then there are chances that the risk which is involved will be higher to as compared to what is there in the fixed deposit. Okay, similarly, a lower return means a comparatively lower risk. Okay, so these two things are very important. Whenever somebody comes you and allures you with all the stuff that you will get a very high return, always the bell should start ringing in your head that yes, there could be a higher return associated with it. Okay, so let's discuss about blue chip, mid cap and small cap companies. So blue chip companies are generally a large companies who have been in existence for a very long time and have a greater capacity to take those hits in the market. What exactly I mean by that? So suppose in last few months, as you have seen, because of COVID-19, market has hit really bad. But there are certain companies which, in spite of market being hit really bad, have come up to their position really soon. For example, TCS, Reliance, HCL, ITC, all these companies are considered to be a blue chip company or large cap companies which generally have a high capacity or a higher cushion to take those hits in the market. So whereas small cap companies are the companies which do not have that capacity to take that much hit. But being said that, you need to understand when you are investing in a small cap company, the risk is high but the return is also high. So let me give you an example. This is a profit chart for a small cap company and a blue chip company for 1 year. A small cap company profit has increased from 10 crores to 20 crores and for blue chip it has increased from 20 to 32 crores. So although the profit in a blue chip company is more than a small cap company, but a profit percentage is more in a small cap company. And that is the reason generally a small cap company gives a higher return. So this is just an example. This condition is not always true, but this is the trend which has been observed in the market. That is the reason why small cap companies generally give a higher return. Being said that, as this series is about mutual fund for beginners, I would highly recommend for you to start with a blue chip company or a large cap company only and do not get into a small cap companies initially. If you really want to earn that higher percentage and want to invest some money, make it not more than 5 to 10% of your entire investment so that you can gain some benefit, but you are not at very high risk. Okay. Also, I want to know that how you have decided and divided your portfolio. What is the percentage of your entire spending is going to blue chip and small caps? So just let me know and I'll definitely guide you and make a video on that, how you need to divide it. Okay. So now this brings us to the number of ways in which you can invest in a mutual fund. There are two ways basically in which you can invest. Number one is SIP, Systematic Investment Plan, and number two is lump sum. What is a systematic investment plan? So if you have ever heard of RD in a bank, it works exactly like that. It is a certain monthly contribution which you make towards your big contribution. So suppose you decided to invest in a mutual fund, a Axis Bank equity long-term mutual fund. Okay, this is just an example, not an advice. Okay, so every month you decided to invest 5,000 rupees. What happened? Every month this amount will be getting deducted from your account on one particular date till the time you will not go and redeem it. Okay, so there is no particular fixed time for a SIP, unlike RDs. Like RD is for 1 year, 2 year, 3 year, whatever time you will decide. In SIP there is no as such time. It can keep on executing till the time you don't want to redeem it. That's right? So now the second kind of investment is lump sum. Lump sum, as the name suggests, if suppose you get 1 lakh rupees suddenly payment from someone and you don't have any use of that and you don't want to keep it lying down in your bank account earning no interest, you can make a lump sum investment, entire 1 lakh rupees. Okay, so now when you are aware of what are mutual funds, what are the type of mutual funds, what are the companies you want to invest in, it is the time to know the advantage and disadvantage of the mutual fund. Very first advantage which you are going to have is a diversification of your portfolio. Suppose you are investing in a stock market, you are investing in one share. However, when you are investing in a mutual fund, you are investing in a scheme like a blue chip scheme or a mid-cap scheme. So you will be invested in many companies which fall under that category. That is how your investment portfolio is built up and your risk is diversified. Number 2, you get an advice of an expert. Number 3 is that you can afford those shares in mutual fund which you cannot otherwise afford in the normal stock market sometimes. For example, you are ready to invest 5,000 rupees every month, but you want to buy a share of Maruti or you want to buy a share of MRF whose price is much beyond 5,000 rupees. In normal clothes, you will not be able to afford it. However, here mutual funds comes into the picture. Why this happens? How come they are able to afford it? Because there are people like you and me who have given their sum of money, which made a pool of money available with them. Suppose so many people have contributed, this money have turned out to be 10 lakh. Now this 10 lakh is invested into a market and the fund manager is able to purchase those stocks which otherwise he was not able to. And these stocks are proportionally divided among all the investors. So what are the disadvantages? So according to me, I don't think so that there is any very big disadvantage of investing in a mutual fund. However, one thing which you should always be careful about while choosing your AMC. Your AMC should be of good repute and it should be of a bigger in size. All this information you can get on a value research site, so you can go and check it there. If you want, I can leave a link below. So now we come to our bonus part, that the things which you need to consider before buying any mutual funds. These things are very important and if possible, take the note down of that. Number 1 is the rating of any mutual fund. So you will get it at very rare places, people telling you this, but the rating of mutual funds, especially a debt fund if you are investing in, is very important. The sites which you can look for these ratings are CRISIL and Value Research. I personally look into these two sites. There are other sites as well, but these two sites are sufficient enough. Even you can go to Money Control for checking that, but these two sites are more trustable. Okay. Number 2 is their past performance. Check their past performance for 1 year, 3 years, 5 years and 10 years. Maybe if a fund is not that old, then up to 5 years is fine enough. See how consistent they have. Like you make a chart 1 year, 3 years and 5 years and see how consistent their performance is in last 5 years. It could not, the graph should not be like this. The graph should be like this. It should be more in line all the 3 years. Okay. Then comes the fund manager. Now this is very important. The only reason, as I said in the beginning, the only reason for you for not directly investing into a stock market and coming through mutual fund is to have an expertise of a fund manager. And if your fund manager is not good, it makes zero sense. Now where to check that? Go to a value research site and if you put a scheme name, scroll down and you will find a name of a fund manager. Now how will you know whether that fund manager is good or not? So the thing is that fund manager name is there and since when he is there in this company will be mentioned. You should generally invest in a company where the fund manager has been there for at least 1 year, because then only you will be able to understand that what kind of performance he gives to these stocks. Otherwise, if he has recently joined, you don't know. The performance which is being shown on the sites is the performance of the last fund manager or not this fund manager, right? Another thing which you need to check is the entry load and the exit load in that scheme. So nowadays generally there is no entry load mostly in any scheme. However, you should check that in the descriptions and everything. Whereas in exit category, generally equity mutual funds have an exit load of 1% within 1 year. So just check that how much exit load is your mutual fund having. So next is an expense ratio. If I tell you in very layman language, expense ratio is a fees which you pay to a fund manager for managing your funds. Now generally this fees is of course paid by a AMC, a mutual fund company, but the company where will they pay the money? So they take that money from all the investors. It is generally a small percentage, 1 to 3%. However, though it seems like a small percentage, in a long period of time, it makes a huge difference in the kind of return you get, because 3% is not one time, it is every time you make the investment. Okay, so always see what is the expense ratio there. Lower it is better. And the last point on which I cannot emphasize enough, when I am making a video and I don't talk about goals, it is not completed. So when you are deciding on the kind of funds, mutual fund you are going to invest, align your goals for it. For any long-term investment which is like more than 10 years, equity will be a more suitable option for you, because then your risk is divided and spread over a long period of time. Whereas when you are looking for a short-term term, then debt or fixed deposits and RD are considered to be a safer options. So when you are making a decision, of course, if it is somewhere in between, you can of course go with hybrid fund as well. So when you are making a decision, always keep these goals in mind. First of all, sit down, write down your goal, and then make investments. One thing which I always tell people, even if you're giving 1 rupee out of your pocket, you should know when a return of 2 rupees will come to you, what you are going to do with that 2 rupees. Until unless you have no idea what you're going to do with that 2 rupees, you will go and buy a candy out of that. Okay, so the main point is your goal should be really defined before making any kind of investment. Okay guys, that's it. I think this session would have been really useful for people who are the beginners, and I tried my level best to explain it to you. If you have any doubt, let me know in comment section. I will be really happy to get back to you. If you like the kind of videos I'm making, do subscribe to my channel, hit a big thumbs up and share it with your friends so that they can also learn about investing in mutual funds, because in today's era, mutual fund markets is only 25 lakh crores as compared to real estate, which is 80 lakh crore, gold, which is 75 lakh crore, and I want more and more people to join in. Okay, so till next time, take care, keep investing, bye.